Knowing the beta of your portfolio can be a powerful way of managing the risks of your overall investments. In this video, I'm just going to briefly explain what beta is and then go on to show you a simple way how you can calculate the beta of your entire investment portfolio in Google Sheets. And then at the end of the video, I will show you the beta of my own personal investment portfolio. And if you calculate it for yourself, I would be very interested to know what yours is. Everybody will have their own strategies and risk tolerances, but it would be very interesting to compare them down in the comment section. So let me know down below if you do calculate it. So first off, I'm just going to briefly explain what beta is. If you want to skip ahead, I've left timestamps down below. Beta basically is a way of measuring the individual volatility of a stock compared to the overall volatility of the total market. It is a historical measure that usually looks back 3 to 5 years at the ups and downs of an individual stock and then look at the overall ups and downs of the market, and they usually run a regression analysis to see what the relationship is between the stock and the market. The most important thing that you need to know is that the market will always have a beta score of 1. And any stock that has a beta value of greater than 1 basically means that it has been historically way more volatile than the market. And then any stock that has a beta value that is actually less than 1 means that it has been less volatile than the overall market historically. If we just take a random example of a stock here, let's have a look at Shopify. Shopify has a beta value of 1.6. So what this means is if the overall market goes up 10%, historically Shopify has gone up 16%. It also means on average if the market has gone down 10%, then Shopify would have dropped 16%. Beta is a great measure of systematic risk. When you invest into any stock, you're going to be faced with two types of risk: unsystematic risk and systematic risk. Unsystematic risks are those that just face the company that you're invested in and don't affect any other companies in the rest of the market. An example that comes to mind here is, remember when Elon Musk went on Joe Rogan and smoked a bit of weed and the share price of Tesla dropped a couple of percent because of that. So that is an unsystematic risk. It only affected Tesla. It didn't drop the whole market. Other ones may be the risk of, say, a factory burning down or a product going out of fashion. Other risk that you face when you invest in any stock is also systematic risk. So these are risks that face every stock in the market. We have seen plenty of these affect most stocks in the market in recent times, such as the potential rise in interest rates, economic uncertainty, and war. What's interesting though is when you add more and more stocks into your portfolio, you actually completely diversify away any unsystematic risk. The unsystematic risk tends to just average itself out. Because if you hold, say, 15 stocks in your portfolio and there's a bit of bad news in relation to one of the companies, more than likely there's going to be some sort of good news in one of the other companies and it all just kind of balances itself out. You don't really see much of an effect on the performance of your overall portfolio. Your performance is more driven by what's going on in the overall market. So if you are somebody who invests in a number of different companies, then it is quite useful to know the beta of your portfolio. And next up now, we're going to go through that and see how you can actually calculate it simply in Google Sheets. So I have just created this random portfolio tracker on Google Sheets. Google Finance have lots of different formulas that you can use that are very useful, and it's very easy to build your own tracker on Google Sheets. They even have a formula where you can pull in the beta for all of the individual stocks that you are invested in. So it's very easy. You can see it here in the top of the spreadsheet here. So it's equals Google Finance, open brackets. Then the formula just needs to be linked to the ticker of the stock that you are invested in, comma, and then in quotation marks beta, then close your bracket, and that should pull in the beta for most stocks. The only issue with it is I think the beta calculation that they do goes back 3 or 5 years. So for some of the new stocks in the market that have only IPO'd within the last year, there won't be any beta values for those ones, such as like Coinbase, for example. So you might have to go elsewhere to get a beta value for the likes of those. So you can go to the likes of, say, Yahoo or Bloomberg or any of those, and you would be able to find one that maybe does the calculation over the last 12 months and just pop it in here instead. Once you have all of the individual beta scores for all of the stocks in your portfolio, then the next thing you will need to do is calculate the allocation of each of those stocks within your own portfolio. So what percentage does each of them make up of the total portfolio? So that is quite easy to do. All you need to do for that allocation calculation is to divide, say for Apple here, it was 3,236 divided by the total portfolio value of 32,369. So that comes out to almost exactly 10%. And once you have all of the allocations calculated for your portfolio, they should obviously add up to 100%. Then it is just a matter of multiplying that allocation number by the individual beta for that stock, and that will give you a weighted average beta. And once you have those weighted average beta numbers over here, then you need to just sum them up, and that will give you the beta value for your entire portfolio. So this random portfolio had a beta value of 1.08. So the beta of this portfolio was not too far off what the beta is of the overall market. It's very close to 1. Where I think this can become very useful is when you are making decisions on what to add into your portfolio and what to sell. You can see what the changes and the overall makeup of your portfolio and see, has it become suddenly more risky or less risky by adding or selling any of your stocks. Let's say here, for example, I went with a much simpler portfolio and I just invested in Airbnb, Fiverr, Shopify and Coinbase. Then my actual beta for that portfolio would have been 1.67. So that is obviously much more riskier, and everybody is obviously going to have their own level of risk that they want to take on, and maybe this is a good way of trying to measure whether you are taking on more risk than you want, or maybe you are not taking enough risk at all and you want to add in a few more risky stocks to up the beta to a level that suits you a bit more. The beta level of my own personal investment portfolio is actually 1.06, so it's actually not too dissimilar to the first one I had a look at here. That kind of suits me down to the ground really. I'm not looking to take any huge risks. It served me pretty well in the last 6 months when things were all going a bit south. If my portfolio had been full of much riskier stocks, then I definitely would have taken on much bigger losses in the last 6 months when we've seen the likes of the threat in rise in interest rates and also the war in Ukraine. If anybody would like access to this spreadsheet, I can share it below in the comment section. Let me know if anybody wants it. That is pretty much it for today's video. I hope you found it useful. Please let me know, as I said, in the comment section if you've done the calculation for yourself and what number it came out to. Thanks again, and I'll see you in the next one.